What if I told you that a massive number of homeowners believe that they are fully protected the moment they sign their mortgage papers, but they are actually leaving their family's financial futures entirely exposed? Today, we want to unpack the critical gaps in the mortgage protection, the hidden differences between bank insurance and personally owned life insurance, and how to properly safeguard your biggest investment. Liam, I'm so excited to have you here today and to break this all down with us. Welcome.
Thank you very much.
Liam, before we dig into the specific of the mortgage, protection, tell us a little bit about yourself. What do you do, and how did you get into helping Canadians with their financial education and protection?
Absolutely. Well, thank you for having me. Yes, my name is Liam Cameron. I am here in the Kitchener-Waterloo region. I actually owned and operated restaurants for 10 and a half years with two partners here in the region, and that gave us a ton of life experience. They were a little bit older than I, and through those experiences, I actually went through their own, my two partners' home purchases, multiple home purchases throughout that 10 and a half years, leading me into being very well coached to buying my own home. The one subject matter that we were never educated on was mortgage protection versus individual life insurance protection. And there's a lot of pitfalls with that. And so now in this new seat, in this new occupation, I have a great opportunity to help other Ontarians, Canadians understand how to best protect themselves rather than the bank.
Okay, so it's interesting how we always start with our own challenges. And we start from there. It's often, right? And anyway, this is what I learned from myself. I need something, and then, hey, I learned about that something, and then I was able to share and help other people with that's new something. So can you replace planning with education? Like CFP is a difficult designation to earn, right? And I would not want to usurp that by using like incorrect language.
Correct.
Just out of respect for those who are certified financial planners, can you explain a little bit, if we can?
Between planning and education. So planning is going to be a start to finish, very holistic process. And a CFP is going to have a direction that they want to pursue with you with that entire interaction. Education is more take it as you need it. And so in respect for the CFPs, I strictly want to help educate because I don't have my CFP designation. Dennis in our office at YourLegacy.ca does. And so we do have a CFP at our disposal when you do interact with me in our office. But it's more for, a subject matter for financial planning would be much more appropriate for him than myself. And that's why I really want to focus on education.
So maybe we'll invite him for a little chat. I don't know if he will be, able and willing and available because always the time is the most currency we have right now, right? Time, it's essential. It's
this mortgage protection versus individual life insurance paradigm is really his bane of his existence right now too. We've been banging our heads against the wall with how do we find a platform that's broad enough and accessible enough for people to find this in a more, not a lackadaisy way, but stumble upon it, or it's not a subject matter that people like talking about, especially in the buying process of the home. A lot of it's often rushed. This is usually a subject
I know.
It's left for the end, right? So we really want to help Canadians and Ontarians especially reclaim the protection that they're probably perceiving they already have. But as you're going to find out, we can do it for a lot less than what the bank is charging you for. And it's much more encompassing.
That's interesting. Okay, we'll touch that topic later, but for now, many homeowners believe they are protected once they get the mortgage. Is
Yeah.
that true?
So there is protection in place. They are not the beneficiary though. So the bank is protecting their investment, right?
Okay.
The bank is deploying capital so that you can buy a home. And if anything happens to you, the bank wants to know that they can get that capital back. And so
Okay.
that's what that life insurance component is. It's strictly the bank taking out life insurance that you're paying for on your life, but you nor your family are the beneficiary, which means you don't get that check if something were to happen to you. The bank does, and then
Okay.
whomever is left has to fend for themselves.
Oh, okay. So it's good to know. Oh my God, it's so many like information. I mean, depends on the individuals if they're like curious to find out more information. But I think this is a very purpose of this podcast, to be honest, because we want to educate the audience what to expect, what they don't know, because sometimes you don't know what you don't know, right? This is the danger,
Classically,
because
yeah.
we think we know everything, but the truth is we don't. So what exactly is mortgage protection insurance, and why do so many homeowners sign up for it?
Right. So mortgage protection is, I'm not a mortgage broker, but I do interact with a lot of them. As far as I understand, mortgage protection, and from my own experience, mortgage protection is deployed and enforced when you're putting down less than 20% of a down payment. So the bank is seeing very little capital coming from you, meaning they're required to beef up their component of the agreement, and they will do that with a clause. And so that clause is to have you and whomever else is on the mortgage sign on for a life insurance agreement that if anything were to happen to, if anything fatal were to happen to somebody that is on that mortgage, the balance is paid. And so there's one really big component to that, is that if you are in a two mortgage owner situation, so a husband and wife are on the same mortgage, the bank actually has opportunity to re-stress test you now that one person is gone. So if you don't have that opportunity to pay off the mortgage, and in an individual life insurance setting, actually have the capital to make those payments, then the bank can requalify you and potentially disqualify you from your current home.
And we don't want to be there. I mean,
We don't want to be there.
it's enough. We have the tragedy in in our lives. We don't want to lose a house or it's that's. I know it's scary, and some people they don't even want it talked about. But hey, this is life, and we try to
We're
prepare
just trying to educate
ourselves.
you on how to play defense.
Yes, and we try to prepare ourselves as much as possible. And when you are prepared, and like I like to say, we have a lot of like medicine in the house, but I always say, oh my God, they're all expired, but I'm happy they're expired, because you know what I mean. I'm not buying.
You haven't had to use them.
I'm not buying the stuff with the hopes I'm going to, because I invested the money in the the medicine or like drugs. I'm hoping not to go to use it. So it's pretty much the same with the insurance, right? Hopefully it's not the case, but if it is the case, then we should be prepared for what's like, it's
well, thank goodness you have it, right? That's really
that's what I'm saying, right? We are not here to say, this is going to happen. It's just be prepared for any situation might arise. So what are the key difference between mortgage protection insurance and personally owned life insurance? If you could explain that to us, would be amazing.
Sure. But you never ask.
Well,
so this is this is a huge. There's probably 8. I won't go into all of them. But mortgage protection. So we'll just go on the bank side of things first. So the mortgage protection from the bank protects the lender, the bank. The benefit. So the amount that would be paid out decreases as your mortgage shrinks, but your premium doesn't. Okay. The bank owns and controls the contract. You have no say. in the policy.
Okay.
And then it is tied to your mortgage, so that if you were to move lenders, you would have to use the new lender's insurance. You couldn't stick around with what you had before. And then there are two big things, all three. One is that the contract is reverse underwritten. So only when a person passes does the insurance company then look into the individual, and they actually have a right of refusal. So if they deem the scenario to be somewhat illegal, or whatever parameters they want to put around it, they actually have the opportunity to not pay out. And the bank does
Okay.
a very good job of not paying out. So keep that in mind when you feel comfortable that you have this protection. And I'm not, in all of this, I don't want to say this is a bad product. There's just much better options out there. Sometimes this product is the only product that works for an individual. So two other things. It only pays the lender. All right. Your family will not be the beneficiary, so they will not get control
Okay.
on how to disperse the funds. Potentially could be a nest egg now that they can just pay the mortgage with, right? So in the bank's product, the bank gets is the beneficiary and gets the money at death. And then for the most part, it's a group rated premium, meaning they're almost essentially guessing that you're overweight in smoke. So they're going to charge you at a rate that is much more expensive on average than a personally owned life insurance contract.
It's good to know. It's good to know. Oh, wow. So they look into these aspects as well. So we need to.
So in comparison to personally owned,
Yeah.
a personally owned contract, it protects your family because you now are in control of it. The benefit, like the death benefit, remains the same no matter the amount of mortgage you have. You own the policy or get to control who owns the policy. You can name that part. You can name the beneficiaries. If and when you move, we usually do move. You can take that life insurance contract with you. It still covers the balance likely that you will be signing on for, and then you are medically underwritten upon approval. So the insurance company knows exactly who they are dealing with prior to signing the deal, and then finally, your beneficiary is named and they get paid. So potentially, if you have 500,000 outstanding and you have $1 million of life insurance, you could take that $1 million and just invest it and continue to pay your mortgage while having the larger capital at work. So, that's the flexibility that we have
covered. So that's great. So you mentioned the smoking. So let's say somebody smoked for, I don't know, 20 years, decides, hey, I don't want to smoke anymore. So how far back they are going to check on you if you're a smoker?
They will ask questions for quite a long history, but generally the smoking rating, meaning the metric that they use to calculate a smoker's rate, is typically only enforced if you have quit smoking in under 24 months. So 2 years and beyond, if you quit for 2 years and beyond, then there's usually no scrutiny shown. And but they will ask about your history up until I think 10 years is typical.
Okay. Probably you also saw on like movies when they have like a different situation like this, and they would even use a social media picture with the person in discussion, like having a cigarette in their hands. It's just a movie, or it can be like real life. What do you think? You know what I mean?
Well,
when you say, I'm not smoking. I quit smoking like 3 years ago. I didn't touch any, because they ask you questions, but then it's to be honest. So if you're not honest, and then, I know, God forbid, you went to a party, you had good time, and you say, let me just have just one.
Yeah.
So it's true.
I promise you won't be the only one that's ever lied to an insurance company, but it's best to be honest. And if it's a one-off, or some companies have a cigar clause, like if you have one cigar or 2 cigars a year, it's okay, sort of thing. It
Okay.
is kind of circumstantial when you get to that, so I don't want to put myself in a corner.
Mm,
But it's in general, it's just best
okay.
to be honest on the underwriting.
Honest. Okay.
And the agent can be very personable with the underwriters. So if they need to color in any lines for the underwriters, we can have a conversation with the individual and ensure that the underwriter
Okay.
knows exactly who they're dealing with rather than just a number.
Mm, okay. I know we touched a little bit about this topic, but if something happens to the homeowner, how does the outcome differ from the family under each option?
So the bank product can be, let's just say the personally owned life insurance is going to be a better outcome
Mm-hmm.
because it's flexible. The bank product can be very rigid, right? So somebody passes away, the bank recognizes that, the mortgage is now paid, you know, so the surviving spouse doesn't have to worry about the mortgage, but that's really about it. They still have to figure out life after death, essentially.
Mm-hmm.
They have to figure out what their new normal is. That's going to take months, if not years. Um,
Absolutely.
they have to now, maybe they weren't the financial literate person in the relationship. Now they have to
Mm,
understand potentially property taxes, all their other insurances, that sort of thing. When it comes to, so that's with the bank just kind of um, getting the deal paid and saying
mhm,
you're a proud homeowner, sorry for your loss. The other side is so the family gets paid the amount. They can actually just ignore the bank and pay the mortgage normally while they figure out their new normal because they have the life insurance. It just gives them a lot more flexibility, and there's no real timeline on the
okay.
decisions they have to make. Whereas with the bank stuff, somebody passes, it gets paid off. There's no extra capital, right? Because it's just the amount that's owed to the bank that
Yeah.
gets paid off, and there's no residuals that come to the family. So if you don't have any other life insurance in play, just the
Mm,
mortgage protection, and
yeah.
that's the biggest thing is that our golden rule is that a family would require about 75% of the household income to maintain their lifestyle.
Okay.
So
So
if you don't
that's
have that
good to
buffer
know. Yeah.
coming in,
Mm-hmm.
the family is now A, grieving, but B, in a very tough spot financially because maybe the surviving spouse can't work, right? They're
Mm,
on bereavement, but a lot of the time that's going to be at a reduced income. And so
yeah.
um, honestly,
Life
life
goes on.
insurance,
That's
yeah, life
you
goes
know,
on. That's the cruel reality is
it
life will
doesn't
continue.
stop. Yes.
And so do bills, death and taxes, right? The only finalities. So, if
Mm,
and especially that's a huge paradigm in many many relationships. My own relationship with my wife,
mm,
um, one of us is much more financially literate than the other, right? So if
mhm.
you lose that person, you've already now that's a massive exposure for the surviving spouse to have to figure out, especially at their most vulnerable time.
I know. Let's talk about misconceptions.
Sure.
What are some of the biggest, I don't know if biggest, but anyway, misconception homeowners have about protecting their mortgages and their family's financial future?
Well, I think like I have insurance through my bank, right? That's exactly what we've been talking about. The one thing I would challenge somebody to that is, especially if I know they aren't a smoker,
Yeah.
I'll say, well, do you smoke? And they say, of course not. You know that. And I'm like, I know that, but the bank thinks you do. What do you mean the bank thinks I do? So from there, it becomes very easy. Just I'll say something along the lines of, why don't you shoot me the amount you owe, your birth date, and actually that's kind of it because at that point I know their gender and I know their smoking status. So I just need to know how much they owe and their birth date, and then I can show them
Mhm.
savings because quite often these payments are being taken out. Well, maybe not bi-monthly. It comes out as your mortgage does. So if you pay your mortgage
Depends
monthly,
on
then it's
the
two
setup.
payments or one payment.
Mhm.
Bi-monthly is two. Weekly it's four. So what we can do is just show you how often you're paying and what you're paying versus what an individually owned life insurance contract would cost. And typically the
Mhm.
savings are around 40%.
Okay. Well, so much information, great information. Thank you. Let's talk about the emergency funds, because I think
Mhm.
it's important to have some emergency funds. Why is important to have this, having this, emergency funds?
Well, capital is what makes the world go round. If you come across an emergency in your life, whether that's a new car, yeah, so maybe your car breaks, maybe your dishwasher breaks, maybe your furnace breaks, maybe your,
Uh,
all these things, maybe there's a leak in your roof, all these things, right? The three options you have are full on savings, full
mhm.
on new money coming in, or leverage yourself. Um, People really don't like people. I mean, Canadians are over leveraged to the T. We all know that. So getting in another loan for an emergency is less than ideal.
Mm.
So pulling on retained earnings or savings is usually the best option. Um, and the simple reason is peace of mind. If you have
Okay.
to leverage yourself, like put a new roof on a credit card, you're paying probably $20,000 at 19% interest. It's
Mm.
gonna that's
Okay.
almost a small mortgage. So
Yeah, I know.
so those sorts of things, we all I think get into the housing market a little naive.
Hmm.
Um, and like our first home was very small. We took it to the studs, and it cost us way more than we thought it would.
Mm.
Very fortunately, we sold in a great market, but it just was very expensive. And it's kind of like a dog or a car. You get it for free. That's base cost. It's going to cost you as long as you have it. So
Absolutely, yeah.
those budgeting kind of ideas, if you can put
Mm.
150 bucks away a week, kind of thing,
Hmm.
hopefully, or 200 bucks a week, kind of thing.
Okay.
That's where, and just put it on autopilot. That's where you're going to find a little bit of a emergency fund or slush fund pile up, and
Yeah.
hopefully you're putting that in something that's very secure, like a high
Hmm.
interest savings account. It doesn't have to be complicated. You just want to know that
Yeah.
it's there, and you want to know that
Yeah.
if you have it invested in the market, potentially it could be on a down market,
That,
and all of a
yes.
sudden you're selling at a
So,
poor time.
yeah.
Yeah.
Thank you
So
for providing
that's
the answer. I was about to ask you how much we should actually have but yeah, I think it's doable. 150, 200. It's not. I mean, it's not a lot, but also it's sometimes it's not easy to have this amount
no.
put
The
aside
golden
every
rule
week.
is
So,
is 3 to 6 months expenses, but nobody
hmm,
can really lump sum that.
I
Like
know.
average living expenses are up probably around the $6,000 to $8,000 on the low for somebody that's in Kitchener
Mm,
Waterloo. In kind of the medium market, that's
yeah.
18, 20 grand just sitting
Mm,
around. I don't think anybody has that.
I know.
I shouldn't
Yes.
say anybody,
And
but
it's a peace of mind also, right?
yeah, yeah.
It gives us a little bit like a financial comfort to know
Mhm.
if we need to replace whatever. It's a must. I'm not talking
Yeah,
about like cosmetics where you all decide I want to change my kitchen,
yeah.
but
It's a need,
we're
not a
talking
want.
about the need, not the
Mhm.
wants here.
Mhm. Yeah.
Um, Most people have heard about TFSA, RSP, and FHSA, but including me, but many still don't understand the differences. So can you please explain the terms for us?
Sure. So think of them as three separate buckets. Okay. Each bucket would have the same investing opportunities, but each bucket has different rules. So the TFSA is tax-free savings account,
Okay.
meaning the income that you earn and pay tax on can be invested in this bucket,
Hmm.
and the income gained from this bucket will remain tax-free so long as you stay under the contribution threshold.
Okay.
I think the contribution threshold from 2008 till now is 107,000. So potentially, if you've been a Canadian resident since then, you have $107,000 of contribution room that can grow tax free. And we already are in an era where we have people who have been investing since 2008 and have more than $1 million in those accounts. So they've done that with very small capital, and the benefit is that all that gain is tax free. So it's tax free contributions up into a limit. And then each year, that limit is given a new stipend So this year it might be another $7,000. We'd be up to $114,000 of contribution room.
Okay,
So that's
so
a
very
tax-free
promising.
savings. Yeah, people are making it work. The registered retirement savings program is a different bucket. So you're like me, we get our income in whole, right? So the typical T4 employee will have deductions, CPP, EI, and income tax. When you make a contribution to your RSP bucket, when it comes to tax time, you will get the equivalent to making your contribution whole, if that makes sense. So pretend you're being paid $100 without deductions. That's what you're going to receive in a. Sorry, let me say that again. Pretend you're contributing $70, but you actually pay a 30% tax rate. So at tax time, you're going to get that $30 back. And the idea is that you put that $30 in with the RSP as well, because then you're taking your untaxed income and investing it. And this does have a limit as well, but it's more calculated. It's less black and white as a TFSA. You're taking that full income, investing it, and then the government is taking their part when you're cashing out in your 60s and 70s.
Okay.
So that's when the taxation.
I think this is a great topic. Actually, maybe we can discuss in another session because I think there are so many questions around this, and it's also I know this. I think more people are familiar with this type of capital. I mean, how do you call it? It's like a capital or like investment. It's like an investment.
Yes, totally. This is
and
investment advice.
often the employer also contributes toward these investments as well, right? So I mean, a good employer will come up with like 3-5%, right? That's
totally.
I know when I worked like in a full-time role, I had like 5%, and the employer would match my contribution, so that's actually great.
In that arena, your 5% just turned to 10, right? You just 2x'd your investment. So
I know.
That is a great tool for
It is.
Employees, and it is quite underutilized.
Okay. Yeah.
And then the third bucket,
right? Yes,
the first home savings account.
Mm-hmm.
So the first home savings account, there's lots of rules around it, but it's kind of a blend of the TFSA and the RSP with its own wrapper. So first home savings account, the assumption is you haven't bought a home yet, but if you have bought a home, it's still worth opening up. You will receive $8,000 in contribution room every year that the account is open, whether you put money in it or not. So just open it. And you will max out at $40,000. So have the account open for 5 years. The maximum amount of money that you can put in it is $40,000. Doesn't mean that that's the value of the account, right? So where the tax-free savings component comes in is you are not being taxed on any growth inside the account. Okay, this is all assuming that it's being used for that first home down payment. Okay, so you're not being taxed.
Home. So is for the first home?
Yes, yeah. So this is ideal for people that are renting. There's actually, if you're going through divorce and stuff like that, the first home savings account becomes a tool for you again. Speak to a mortgage professional, an accountant. They will have the best strategies for people in unique situations. But in grand terms, it's really for the people that are renting, that are looking to buy. And so the money goes in tax-free. And your after-tax income goes into the account and grows tax-free. And then the RSP component is every dollar that you put in, you get your rebate for as well. And the idea would be that you put the rebates of your FHSA contributions in there as well to make it a larger investment. The one thing that is lesser known about this account, and it's brand new in the world of accounts, is that if you don't use the account for 15 years, it will roll into an RSP. It'll become an RSP. So there is a timeline.
So you don't have to do
and nobody has reached that. nobody's reached that point because it's such a fresh account. It's only been around for 3-4 years.
Oh, okay. So it's
But the
only
rule is if you haven't used it in 15 years, it will become your RSP or another RSP for you.
okay. For someone planning to buy a home in the next few years, how should they think about using those accounts to reach their goal?
Yes. So I would really focus on the contribution amounts. So see how much contribution room you have within your RSPs and TFSAs. Make sure you have a first home savings account open. The first 8,000, and you can do this for I believe for both. If you're married or if you're buying a house together, I believe you can do it for both of you, so long as you're both first-time home buyers. You actually can't have one first-time home buyer and a current homeowner involved. It'll nullify. But make sure you understand the contribution rooms. So if you want to put something that's a steady growth product for that $8,000 for the first home savings account, and just be very confident that anything growing inside of there is going to be there when you need it, then you can maybe take some more risk on an RSP arrangement or a TFSA arrangement. There is RRSP
I know.
home
I'm having
buying
sometimes
options as well.
problem.
Yes, the RSP borrowing kind of fast tracking, like pulling your investment and using that for your down payment. It's still around. It is getting phased out a bit by the first home savings account because it's extremely complicated. It's an underutilized product, maybe by design because it is so complicated. So what we've been hearing is this, take this for what it's worth. But I believe the first home savings account will be a much more effective way of getting people to save for a home rather than the RSP route, because the RSP route, if not paid back consistently and intentionally, can really muddy things for your retirement planning. So because that is interconnected, it is much cleaner to focus on your first home savings account and then your TFSA as well. TFSA is great, but if you can max out the TFSA and just have it kind of cooking on the side, all that growth is tax-free. So if you don't have to interrupt it, I wouldn't.
Complicated. It's complicated, but this is why we have you. So you will help us navigating this very complicated.
So just to tie it all together, I'd say focus on your first home savings account first. Then look at your tax-free savings account, because your tax-free savings contributions reset every year. If you pull out, let's say you maximized your contributions this year, and then you pulled them all out this year, well, come January 1, you will be able to have that room back, whereas there is no forgiveness in RSPs. So the RSPs would be the last thing you touch.
Okay, that's good. Very good to know. We talked about the first-time buyers. If you were advising like a first-time buyers today, what are the first financial steps you would recommend before they start shopping for a home? Because we see often, and I see like they got excited, but they have no plan, like financial plan. So what do you suggest? What are the steps for the first-time home buyer?
First things first, I would manage expenses. What are you spending money on? What are your wants and needs? And then really be honest with yourself about your needs. That's where you're going to find the most room where you can save. It depends where they're at, but maybe a side hustle for a little while is appropriate so that you can work towards a number. Find a realtor and a mortgage broker that you like. Don't put yourself in a position where you all of a sudden need anyone who can do the job, because quite often your values, your wants, and your needs are not going to be reflected in that deal. So take the time to do some research on people that you enjoy working with, and they will likely be the best candidates for your business. Okay. So those would be, and they will also become your centers of influence for these decisions, because the mortgage is your biggest financial tool.
Absolutely.
Right? When you get that, once you're in, it just takes a lot to get in. The stress testing, all that sort of stuff. So be very aware of the stress test rules. That's my wife and I got in 2017, November 1st, really 2 months before stress testing was ever invented. And at that time, we would have failed, but we were very fortunate to get in what we got. And it's been like our mortgage is our bedrock for kind of our lives. And when we want to take a risk or anything like that, we know that we have the mortgage. So, yeah, just be very aware and find professionals that you like. Don't go to the bank directly. I'd say don't go to the bank directly, especially if you're self-employed. There's going to be much better equipped mortgage professionals that can help the self-employed. Find an accountant that enjoys what you do for an occupation. If they show interest in what you do, they will likely know how to best navigate your future wishes. And then find a real estate agent that really speaks to you.
That's amazing, because what happens is often when we see people like, oh, but my cousin did this or my friend did that. So people they need to know each situation is different. They might look alike, but honestly, and we are seeing in the real estate, they want the same price for their house, comparing with their friend's house that was sold maybe 3 years ago.
Right. Yeah.
But hey, the market changed. The houses are like they're not the same houses. They're not the same street. It's there's so many components you have to take in consideration, and it's the same here, right? Don't just compare to somebody else. Make sure you speak with somebody who is in the field, expert, and gives you the everything, not just the good news. Because
when I'm asked for a price, sometimes people are. I've had this conversation quite recently a few times where they just want to know price, and that's not fair to you. If I spit a price out for you, at this point we don't know each other well enough to ensure that the price that I'm showing you is the product that fits your needs best.
Exactly.
So I would just treat yourself as a snowflake. You are different than everybody else, and so is your situation. It might be similar, but it's not the same. And so you need to find the professionals that will treat you like a snowflake so that you can ensure that you are making this huge decision once.
That's right. Oh my God, they were amazing. Thank you so much. A lot of information, and I'm pretty sure I hope we'll get also questions. Where people can find you? I know this is how I found you actually on Instagram, right? You're active on Instagram. You provide so much valuable information there, and I was like, this is the perfect person to be in the podcast. So,
cool.
So thank you so much
I can be found on Instagram easily. Yeah, Instagram is easy. In person, I'm always around. LinkedIn is kind of my storefront. Again, I had restaurants at one point, so people used to come to me, but now I have to come to them. So LinkedIn is the best representation of who I am. Instagram will give you some human, it'll give you some in-person updates. And then I can be found here in Kitchener at 508 Riverbend Drive as well.
Okay, thank you so much, and I really hope we'll see each other again, and with different topics, maybe a little bit more specific for each category. Today was more like a general coverage for the topics, but I really hope we can get a little bit deeper in maybe one of each topic we covered today.
Sure. Yeah.
Okay.
Yeah. I'm open to it. Yeah. Thank you very much.